A $1 trillion mistake was obvious to one man. Frank, a taxi driver, had seen the writing on the wall. He spent his days in New York City watching. He heard stories from passengers. He listened to their struggles, their hopes. By 2005, Frank noticed a strange pattern. People were buying houses they could not afford. Mortgage brokers pushed loans with low initial rates. These were adjustable rate mortgages. They started cheap, but quickly became expensive. Everyone called them liar loans because buyers often misrepresented their income. Frank saw this happening everywhere. He heard people talk about owning 3 or 4 houses. They had no real income to support these properties. This was a massive red flag. The financial system seemed blind to this truth. Big banks kept packaging these bad loans. They turned them into complex securities called mortgage-backed securities. Then they bundled these further into collateralized debt obligations. CDOs were sliced into different risk tranches. Even the riskiest parts were given high ratings. Ratings agencies like Standard & Poor's and Moody's gave AAA ratings to junk. This was baffling to Frank. He saw houses selling for $500,000. Even $600,000 in areas where historically they sold for $150,000. The numbers just did not add up. He spoke to anyone who would listen. He tried to warn people. His warnings often fell on deaf ears. People simply laughed at his simple explanation. They trusted the experts. Wall Street pros said the market was sound. They said housing prices only went up. Frank knew better. He saw the subprime mortgage market as a house of cards. Subprime loans were given to borrowers with poor credit histories. These loans carried higher interest rates. But the adjustable nature of them meant those rates would jump. Frank predicted that homeowners would default in huge numbers. He saw families struggling to pay even the initial low rates. What would happen when their payments doubled or even tripled? The answer was simple. Foreclosure. Millions of foreclosures would flood the market. This would drive housing prices down. It was a vicious cycle. He knew a collapse was imminent. His daily interactions gave him a unique perspective. He talked to real people struggling with real debt, not abstract financial models, not computer algorithms, just raw human experience. By 2006, the signs grew clearer. Housing starts began to slow. Mortgage applications decreased. Frank heard more and more stories of people missing payments. He saw vacant houses appearing in once bustling neighborhoods. He spoke of a bubble, a massive housing bubble that would pop. The financial world remained in denial. They continued to profit from the packaging and selling of these toxic assets. It was all about volume. Selling as many loans as possible, getting those upfront fees. The long-term consequences were ignored. Frank saw this as pure greed. He questioned the ethics of it all. How could so many smart people miss something so obvious? He felt a sense of dread for what was coming. The year 2007 brought more bad news. Major lenders started to collapse. New Century Financial, a large subprime lender, declared bankruptcy in April 2007. Bear Stearns, 2 of its hedge funds, collapsed in June 2007. These funds were heavily invested in mortgage-backed securities. It was a sign of things to come. Frank observed the nervousness growing among his wealthier passengers. They started asking questions they should have asked years earlier, but still no one connected the dots properly. They thought it was contained. They thought it was just a few bad apples. Frank knew it was systemic. It was a rot at the very core of the system. He kept repeating his simple message. The housing market was not sustainable. It would fall, and it would take the economy with it. Then came 2008. The year everything changed. In March 2008, Bear Stearns was acquired by JP Morgan Chase for a fraction of its value. It was a government-backed deal. The first big bailout. Frank saw this as a panic move. It confirmed his worst fears. The government was trying to prop up a failing system. He continued to watch the news and talk to his customers. He heard about more banks getting into trouble. Fannie Mae and Freddie Mac, the government-sponsored enterprises that backed trillions of dollars in mortgages, were seized by the government in September 2008. This was a huge step. It showed the scale of the problem. Just days later, on September 15, 2008, Lehman Brothers filed for bankruptcy. This was a catastrophic event. It sent shockwaves around the world. The 4th largest investment bank in the United States was gone. Frank recalled the day vividly. His cab was quiet. People were in shock. They could not believe it. But Frank, he had expected it. He had been waiting for it. The dominoes were falling exactly as he predicted. Merrill Lynch was sold to Bank of America on the same day. American International Group AIG, a giant insurance company, received a $182 billion bailout from the government. The numbers were staggering. Trillions of dollars of wealth evaporated. Stock markets plummeted. The Dow Jones Industrial Average fell by 777 points in a single day. That was its largest single-day point drop in history. The global financial crisis was in full swing. Unemployment rates soared. Millions of jobs were lost. Families faced immense hardship. Over 4 million homes were foreclosed between 2007 and 2010. Entire communities were devastated. Frank saw the pain firsthand. He drove people who had lost their homes. He drove people who had lost their jobs. He drove people who felt betrayed by the system. He felt a mix of sadness and validation. Sadness for the widespread suffering, but validation that his simple observations were correct. The experts had been wrong, the taxi driver had been right. It showed that sometimes the clearest view comes from the ground up, from the people who live and breathe the consequences, not from the lofty towers of finance. It was a lesson in humility, a stark reminder that common sense can often trump complex algorithms. Frank kept driving. He kept listening. He knew the world had learned a tough lesson, one that cost billions of dollars and countless ruined lives. The recovery was slow, it took years. The economic scars remained for more than a decade. The national debt increased dramatically. It was a crisis born of greed and a complete disregard for risk. A simple taxi driver saw it all coming, with just a fraction of the data available to Wall Street. His intuitive understanding of basic human economics was far more accurate than any sophisticated model. It was a truly insane period in history.